This is Colin Hamilton, Commodities Analyst at BMO Capital Markets. Thank you very much to the 1-to-1 group for allowing me to present to you today, and over the next 25 minutes or so, I'm going to run through how we see the fundamental perspective for many of the metals and bulk commodities under our coverage. I'm going to focus quite a lot on the macroeconomics because, of course, in the fast-moving environment we're in at the moment, I think that's very important to try and appreciate. Now, my job at BMO is to look at just the commodities side, but I'm part of a wider team of individuals who cover companies across the spectrum of base metals, bulk commodities, precious metals, and indeed battery raw materials. If you would like to hear more from us at any point, please do reach out individually. So the key things I'd like to get across today. We are, of course, in a rapidly moving environment, and estimates are changing on a daily basis, both for demand and indeed supply. But I would say the former, so demand, is probably the greatest concern at the current time. And while demand leads the cycle, supply reacts to it, and how quickly that supply reaction comes through, and I'm talking about cuts here, determines the level of inventory build that we're likely to see. The quicker these cuts come, the better in many cases. Now, China is of course starting to recover. It's getting better, and it's getting better quite quickly. Recent data points have been strong, surprising on the upside, and that's on the back of old school demand support measures, so pushing back on infrastructure to bolster the economy. And that's going to be a key. How that cycle works is going to be crucial for commodity markets over the coming months. But in end demand globally, there's certain areas that are a big concern to us. Aerospace, autos, consumer durables. The consumer exposed areas are certainly our concern at the moment. Of course, we're getting a government response, and we're getting a very strong policy response from governments across the world. In the medium term, that supports all commodities, but in the short term, it's definitely a positive environment for precious metals. And lastly, I would say the role of the scrap market, and that's both in the short and long term, is still underappreciated in markets, and I will talk about this as we go through the presentation. So I'd like to start by looking at some of the key macro indicators. And in terms of a shock, while the backdrop might be different this year, 2008, 2009 offers perhaps the best guide of where we're heading at the current time and in terms of data that we might see over the coming quarter. But this time around, it's come in a period where trade was already starting to struggle. For example, global trade volumes were negative year on year in 2019. Global industrial production, on the right-hand chart there, had been steadily grinding lower, and we were at 1.1% growth for 2019 as a whole, but of course both of those are now starting to go negative. It did look earlier in the year like we might have found a bottom, but we are now looking at severe contraction in both these areas over the coming months. We are factoring in a recovery in industrial production through the second half of the year, but what I would say, we've got a reasonable handle now on the amplitude of this downturn. Duration is now the issue. Base case is that recovery coming through, but there's still a number of issues to face over the coming months which will determine the extent and indeed the speed of that recovery. And just to look at some of these global indicators, they are pointing to this deceleration in activity we're seeing. The OECD leading indicator, published by the OECD, takes into account a whole raft of measures that had started to follow the Asian push positive, if you want, towards the end of last year, as trade friction looked like it was starting to ease. But of course, as we've headed into 2020, we've seen that sharp turn down. And that's mirrored in the moves in manufacturing PMIs. So in that right-hand chart there, we are seeing that global PMIs, we are in a position at the tail end of last year where still the majority were contracting, but it looked like less and less each month we're going to contract. Now we're in a situation where contraction is universal. Pretty much all the global manufacturing PMIs we cover around the world are contracting. And that does point to the downturn in demand that we're seeing at the current time. Rather than focusing on where demand is right now, though I will talk about that in a minute, I think it's important to think about the medium-term effects of this. We have seen a big shock to consumer confidence. What I put up here is just the US Conference Board Consumer Confidence Index, and you can see that drop in the present situation we've seen was the largest since 1973, since the oil shock back then. Expectations have held up well, but I'd look at that present situation. After the global financial crisis, it took 6 years to get back to the levels heading into that crisis. So it does take a while to rebuild consumer confidence. And this is an interesting recession from an economic point of view, in that it's affecting the consumer a lot more than it's affecting the manufacturing side, certainly at present. If you think of it, shops and restaurants around the world are still closed, but many of the countries, as they're coming out of lockdown, factories are going back to work first. So with that, it is interesting. The consumer side of metals demand is where we're seeing a lot of pressure. The right-hand chart looks at, again in the US, just plans to buy over the next 6 months. You can see some of those big ticket items, certainly autos, the weakest we've seen in quite a while. Also appliances have also been weakening. So it is going to take a while to get the consumer back in many of these markets, and through that process, we will have to destock some inventory. But let's take a look at the physical market at the current time. And I've used the example of aluminium here. The left-hand chart looks at the aluminium premiums. And this is what you pay, of course, over the London Metal Exchange price to take prompt delivery of material. They have all moved lower, but let's look at that US one. We've now effectively lost the tariff premium. It's back to levels we saw before import tariffs were put in place under the Section 232 ruling. To get to that type of situation, it gives us an indication of where spot demand is. It means that US demand can be serviced by domestic production and imports from Canada, which are not subject to the same levies. As a result, that points that spot demand is down perhaps in greater than 40% at the current time. And that ties in well with what we saw in China. I've put up Q1, China's aluminium consumption on the right-hand chart there, and you can see in our numbers it fell 30% year on year. This is the depth of the downturn that we're looking at in markets at the current time. So China offers us a precedent. The rest of the world is now coming through, and it's a major hit to demand. Though it's not as though all end uses are seeing exactly the same impact. As I mentioned before, autos is definitely an area of concern at the current time. We currently model about a 12% fall in auto sales this year, though that number could be it could be flat year on year, it could be down 30%. There's still a great unknown there. We're looking at an industry that was already facing change with the emergence of electric vehicles. And what an interesting thing, we do think that the electric vehicle sales will hold up better than internal combustion engine sales over the year as a whole, helped by strong European numbers. But at autos more generally, we are looking at a downturn year, and it could take a number of years to get back to 2019 levels. That is of course important for many of the industrial metals overall. I'd also highlight that aerospace demand, again important for some of the lighter commodities, well that is, we're seeing capex spending there cut back severely. But COVID-19 has not all been bad for end uses. I'll just highlight on the right hand side there that we've seen sales of beverage cans pick up very strongly with people at home and with pubs and restaurants not open, and that's both on the alcoholic and non-alcoholic side. So some downstream sectors are actually seeing a bit of a boost. It may be a bit of a one-off, but it's part of a longer term trend, I would say, where people will hold a little bit more inventory, whether that be at the manufacturing or consumer side, just in case of events like this in the future. But all in all, we often get told that commodities trade as an asset class and everything moves together. That has certainly not been the case over this year. We've seen some quite significant divergence depending on the fundamentals of the individual commodity markets themselves. For example, oil price down about 80% year to date, gold prices up about 12%. What we've seen though is a number of the metals kind of grind lower thus far, but we are now starting to trade into cost curves, and that's where we should be. The chart on the right hand side there looks at prices against the 90th percentile of the cost curve, and you can see we're now at levels that are starting to cause pain on marginal producers. Not in all commodities. Manganese ore, iron ore, gold, for different reasons, are all still trading above the cost curve, but in most other commodities we are now trading at levels to try and force marginal suppliers out the market. That's what you naturally have to do in demand downturns, and the quicker that supply reacts, the less inventory is built and the quicker the recovery can be in many markets. I now want to look at the supply side of the equation, and while demand's been impacted by COVID related restrictions, of course so has supply across a number of metals markets. And that's naturally led to a change in the mindset of producers, and they are of course naturally uncertain about how the lockdowns that we're seeing in many mining jurisdictions will affect them. So I put a chart up there showing the number of companies that we look at who have lowered or suspended guidance so far, and we're up to 35%, and that total is rising all the time. That plays into the uncertainty that we're seeing. From a commodity point of view, how have I tried to deal with this? Well, I have upped my disruption allowance that I put through the models to account for unknown supply failings. I've upped that by 50% this year across the entire coverage of commodities that we have. Now, what I would say is we've been eating through that disruption allowance quite quickly. So, of the commodities that we track, in terms of the capacity that's been impacted, we've been up as high as 25%. 1/4 of global copper supply at one point was impacted by lockdowns, as was 1/4 of zinc supply. And we're starting to see revisions down. Now at BMO, we're keeping a supply tracker across all the companies we cover. And so far, in terms of production expectations for 2020 now versus what they were at the start of February, so before COVID restrictions became mainstream, well, we've lowered uranium production forecast by 19%. Uranium, of course, a market that was already in deficit coming into this year, and now we've seen more supply restrictions coming through. The PGMs, up to 15% of platinum supply offline. Again, partly that's down to Anglo smelter restrictions, but also it is down to the lockdown in South Africa. And you see among the base metals, the numbers are creeping up as well, and we'd expect those to rise further as we go through the year. Of course, we're going to see a whole change to the supply side of many industries. Shift patterns may have to change, and with that, there is still going to be a lingering impact on the supply side of the equation. So unlike a normal downturn whereby demand moves and then supply has to react slowly, we are actually seeing short term some supply taken out of the market. I am thinking, of course, we are now seeing countries come out of lockdown, and as part of that, you would expect to see that over the next little while, we probably will have a little bit more raw material supply in many markets at the same time as demand is weakening. So just bear that in mind over the coming couple of months. Now, while we're on the supply side, one very important and often overlooked point about balancing markets in weak environments is scrap, secondary material. It is the most price sensitive form of supply out there in the market, and lower prices do not attract back scrap. And also, we've got weak industrial activity, so weak prompt scrap, and we've got no recycling centres open. We've got limited collections, no one out there in the streets when they're all quarantined. With that, we've also had post-consumer scrap be down. With this lack of collection means that across many metals, so steel, aluminium, copper, we're going to see heavy losses from the scrap side this year. That alleviates a little bit of the pressure on primary mine supply to cut. Now, this lower scrap is really just a 2020 story. We've seen it come through China. This is part of the reason why iron ore prices have held up so well, and that the scrap market, we haven't seen collection and ferrous scrap consumption in China was down as much as 50% in March from pre-Chinese New Year levels. But we should see that recover as industrial activity comes back. Longer term, scrap is very strategic in many of these markets, as metals and mining as an industry comes under pressure to lower the carbon footprint. The quickest and easiest way to do that is to up the proportion of scrap used to make refined metal. And we do expect to see that become, as I say, much more strategic in supply chains over the coming period. Of course, it does lessen slightly the need for many raw materials. So if you think metals markets are bad, well, spare a thought for the oil market. There we're looking at a situation where spot demand has fallen very rapidly, but at the same time, you have supply growth from key suppliers as Saudi Arabia ramp up output. And of course, you have no scrap in the oil market to try and take material from. We think that global oil demand might be down as much as 17 million barrels per day in the second quarter. And of course, with that, the price has come lower. Now, how does that impact onto metals markets? Well, two ways. Oil is a big proportion of many commodity indices, so as that falls, assets under management and commodity indices also can trend lower. But perhaps more importantly, we do see that a good proportion of cost structures are of course linked to oil. Much more so for the bulk commodities, which are simply, putting material on diesel trucks and bunker fuel vessels and shipping it to China in many cases. But even for some of the base and precious metals, oil linkage can make up a significant proportion of costs. Now, as the oil price falls, cost curves fall with them and naturally get shallower. And the second impact that we're seeing there on the cost structure is FX moves. Obviously, we've seen a weakening against the US dollar of many producer currencies, and that also serves to make cost curves shallower. So that means that in an environment where we're trying to take supply offline, the price can often have to work a little bit harder to get the desired result. It's not just oil, though, that's been under pressure. Other energy commodities have also been falling. The left-hand chart here shows thermal coal. And, of course, it's the closest I ever saw the Chinese government to panic was in late 2015 when the coal industry was struggling to pay its workers, who were struggling to pay their mortgages, and the banks had a problem. Then we had the whole reflation trade of supply side reform and 276-day mining policy, and with that the NDRC came up with their zones. We are now below the NDRC's green zone. We're actually below the intervention level now, where they've said they would step in and support the market. Now what's very interesting is that we're not seeing active approach to intervention. They're not telling mines to cut supply, but they are suggesting they don't want to see the price any lower. So it's very much soft rhetoric style intervention at the current time. I would be expecting many of these energy markets, coal, and you've got LNG there on the right hand chart, and now as low as $2 per MMBTU on a delivered Asia basis. These prices may be under pressure for a little while. We could actually see some very low gas prices into Europe. Now of course that also again plays into lower cost structures for the mining industry as a whole. So let's talk China for a minute. I mentioned right at the start that we're seeing China resorting to old school tactics, and by that I mean when the going gets tough and the consumer is weak, which is definitely what we're seeing at the moment, China tends to pull the infrastructure lever pretty hard. And we're definitely seeing that at the current time. Industrial profits have been weakening. That brings the corporate debt problem back into focus. And with that, we're seeing very much a demand side approach to supporting the Chinese economy. What do I mean by that? I mean they're offering up a lot of fiscal support to try and get things going. We're not seeing too much cuts to the supply side to try and reflate the economy, mainly because, like many other economies around the world, China has seen quite a big rise in unemployment over the year to date. They don't want further unemployment because that could potentially drive further unrest. So with that, it's very much a demand-focused approach. What are we seeing? Well, the right-hand chart is very important. That is the special purpose bonds at a local government level are the Chinese government's new tool to try and support infrastructure projects. And we've already seen more of these issued in the first 4 months of this year than we saw over the whole of last year. That highlights how aggressively they're targeting getting the economy going through infrastructure spending. And with that boost infrastructure spending coming through, we're expecting to see fixed asset investment in infrastructure, which has been very weak actually over the past few months. Well, we're expecting to see that recover and maybe be up as much as 30% year on year over the coming months. But there's one very important contributor that we're starting to see come through. The state grid, biggest consumer of copper in the world, significant player in the aluminium markets. Well, as part of the efforts to support the economy, the state grid, who have been subdued, if you want, for a couple of years, have now seen their budget for ultra-high voltage power line investment upped from 33 billion RMB to 181 billion RMB, almost a six-fold increase. And we're seeing approvals of new ultra-high voltage projects at the highest level since 2015, and the second highest, in fact, on record. So this is just one tangible evidence of the approach that China's taking to try and kickstart its economy. The other area we're seeing China as being very active, and this kind of evokes memories of the first half of 2009 when China was recovering and the rest of the world was weakening, is a soaking up of commodity excess. And by that I mean any available commodity that's out there at the moment that ex-China suddenly doesn't want. So with Europe weak, with Japan weak, with the US weak, well, that's heading for China. I've just given two examples here. Iron ore. Actually, currently we're seeing 80% of Brazilian iron ore going to China, which is very unusual. Normally that would be 50 to 60%. And we're seeing almost 90% of Australian iron ore headed for China. So these are levels that we last saw basically coming out the GFC when the rest of the world was extremely weak, and we're seeing the same again. And it's not just related, we're seeing the same in copper concentrate. China's April trade figures showed some very strong growth there. And we're seeing it in crude oil as well. A lot more tankers are heading China's way, simply because the rest of the world doesn't want them. Now, this is partially strategic, both at a central and local government level, but also with working capital loans freely available to Chinese corporates at the moment. Well, they are taking this opportunity to stock up on raw materials at the present time. So this is a big strategic push from China to source commodities when no one else wants them, and it's certainly helping to prop up demand in a number of markets. So that of course leads us to ask the question, are we underestimating China? Because it's happened before, I would say in 2009 and indeed in 2016, everyone underestimated the strength of the Chinese recovery. And we have seen this film before in terms of a credit fuel push from the fiscal side, infrastructure led. Well, recent data points have of course been quite strong. I'm going to highlight two here. Actually, consumption of rebar in the Chinese economy has been at a record at the tail end of April. We've never seen levels of rebar construction, steel rebar for the construction industry be as strong. We're also seeing cement inventory, which had built quite aggressively through February, March, being drawn down almost equally as aggressively in recent weeks. And the right-hand chart on this slide is a key one to look at. It's the operating rate at China copper wire and cable fabricators as surveyed by Shanghai Metal Market. And you can see in April that ran at 100%. Wire and cable fabricators were flat out. First time we've seen this in this survey. And again, it's all down to state grid orders coming through. There is a thought that some of this is material being pulled forward ahead of the tolls coming back in China. So China removed all expressway tolls until the 1st of May. Of course, now that we're getting past that period, we'll wait and see if there has been a pull forward of demand. But on the whole, China's data points are definitely coming in a bit stronger than I might have expected 6 to 8 weeks ago. Just to conclude on China, while we don't believe that the strength in China is enough to offset the weakness in the rest of the world, in the short term at least, and to be clear, as ex-China recovers and the China fiscal spending is still coming through, we actually see a potential for some overheating in metals prices as we head through Q4 and Q1 2021. But for the here and now, China is just doing enough to help partially offset weakness elsewhere. But I would say it's giving a good go at that. And some of the key indicators here, so Chinese property sales are now back in positive year-on-year territory, 3 months after Chinese New Year. And also car sales, which have been particularly weak over the past 18 months. Well, now we're starting to see that also back in positive year-on-year territory. So some of these key metal-consuming sectors in China are definitely looking a lot better. Now to move on to some of the key individual commodities themselves. And we're going to start with the gold market. Strong performer this year, only surpassed by uranium in terms of year-to-date performance. And of course, what we're seeing is this ongoing precious positive environment. Very loose and getting looser monetary policy. Yields at very, very and record low levels in many cases. And just give an example, I mean, the Federal Reserve, of course, everyone looks to them. Their balance sheet is, of course, highly accommodative. We're seeing almost a printing of money at the scale we didn't even see in the global financial crisis. And the backstops that are being given are very, very aggressive. And then gold has continued its correlation with 10-year yields. Of course, the yields themselves are maybe less able to offer further tailwinds, but still, in this environment, it's very supportive for gold more generally. We're in a world where gold is still offering a yield when not many other things are. In terms of gold though, I mean, it's not like everything's going one way from a demand side. Of course, jewellery demand at the moment is extremely poor. No footfall through jewellery stores, online markets not really there, and of course consumers are still pretty cautious and are trying to save cash up rather than make big purchases. So we saw jewellery demand for gold down over 30% year on year in Q1. However, we have in the gold market, we have had this nice offset in recent times where micro asset allocation is perhaps weaker, and we're certainly seeing that from jewellery, although I would say coin sales are stronger this year. Macro asset allocation is offsetting that, and we're seeing still very strong ETF flows. Now, ETF flows we view as crucial in terms of price formation in the gold market. If we just look at the right-hand chart here, that is the correlation between quarterly changes in the gold price and quarterly changes in holdings in the gold ETF. And you see a very strong positive correlation there. Now, through this year to date, we've seen big, very strong and consistent gold inflows. And we view, of course, in the longer term, ETF flows as an annuity for gold. They're a function of wider assets under management. And as long as assets under management are rising, then gold will benefit from that. But in the short term, of course, it's portfolio rotation. Macro asset allocators at the moment are naturally defensive, and even if they're thinking about putting on a bit more risk, that's going to be hedged with a slightly higher weighting to gold just to make sure they're protected in that environment. So we still see strong ETF flows. ETFs will exceed central banks in terms of positive contribution to gold demand this year on our numbers. Overall gold demand could be down actually as much as 10% year on year with weak jewellery, but because ETFs are basically the be all and end all in terms of setting the price on a daily basis and are less price sensitive, we view that still very supportive for gold, and we do see the gold price trending higher still over the coming 12 months. And with gold prices going higher and costs, as we mentioned before, trending lower, that has opened up a nice margin for the gold industry. In fact, the vast majority of the gold industry now is extremely profitable at the current time. And if we look at that chart on the left-hand side there, it's shown that this has not always been the case, of course. The gold price and the 9th decile of the gold cost curve have moved pretty much in tandem for much of this century. But now we're in a situation where the gold market, of course, can return. We're not seeing supply growth like many areas. We're seeing capex pull back, and that does mean we are passing through the peak of primary gold mine supply. But from here, we're still seeing a business that should be able to balance the books a little bit better, offer some returns to shareholders, but also invest in sustaining capital and technology improvements, all of which will make it a much healthier industry. And of course, the performance of the equities this year is getting generalist investors interested once more. And just to look at the right-hand side there, that is the gold to oil ratio. It's not really a ratio we talk about very much, but with gold going one way and oil going the other, you can see how that ratio has really blown out over the course of this year. I want to spend just a minute or so on silver because, of course, it's gold's forgotten sister to a certain extent. Now, silver price cannot decouple from the gold market. It's still still intrinsically linked to gold. However, in our view, it's set by different end users. Yes, silver ETF flows are there, but they're sporadic. They can be meaningful when they come, but macro asset allocators do not have a mandate often to own silver in their portfolio, whereas they do for gold, hence why gold gets the annuity and silver doesn't. That's why the gold to silver ratio has blown out over recent times. Silver, though, does offer a lot more torque at turning points in the cycle, and where we think there's an opportunity here is that as governments move to the next stage and following the China path to a certain extent, and start to bolster economic growth and recovery through fiscal spending, well, that's where silver can gain some benefit. Silver, to a certain extent, is moving towards being more of an infrastructure metal in many cases. We're seeing the growth areas being photovoltaics, so for solar demand, and also for 5G build-out. So all these things that are coming through are going to support the silver market and support demand growth going forward. We're not saying silver is dramatically, we're going to get the gold to silver ratio back to historical norms, but we do think that silver can outperform over the coming years, and there's an opportunity at the current time to see some catch up following the sell-off in silver we saw earlier on in the year. One of the more resilient commodities this year, and perhaps surprisingly so given the wider weakness, has been iron ore. The iron ore price itself has actually been trading in a higher range than we saw for much of last year, and that's even with the fact that we have not. Last year was feeling the impact of the Brumadinho situation, which is steadily getting a little better over time. Now, in terms of iron ore, I think a key thing was the reduction in scrap availability in China over the first part of the year, but that in itself is now being solved. But the other things that are keeping iron ore at least supported are high Chinese steel output. We've seen that much more resilient than we might have expected through the downturn period. But also the supply side from the majors has been a little disappointing. It does look like we might get another year of no growth in supply from the majors. Now with that, it means we don't have to aggressively displace iron ore in a weaker market environment. In fact, we see global trade as roughly flat this year. It's not to say we don't expect the price to drift a little down. We would expect the iron ore price in the 70s for much of this year, so $70 to $80 a tonne rather than $80 plus, which has been year to date. But that's a very good price for many of the iron ore miners out there. And with freight rates having fallen so aggressively with the oil price collapse, well, that leads it to be a very good margin business. It's not a growth business in the medium term, but in our view, it's going to be a very good margin business over the coming years. And taking a look at copper. Now, this was meant to be the year of deficit for copper. We're coming into the year, we'd seen a deficit in 2019. Supply was continuing to struggle and has indeed struggled this year. But of course, with the drop in demand, and we are factoring in between 7 and 8% drop in copper demand this year, we now are running a slight surplus in the market. What's interesting, our 2021 balance has actually improved a little because many of the projects that were due to come in copper have been pushed back by 6 months or more. All these big copper projects, the greenfield projects that we've known about for a while and were coming, well, they're coming but a little bit later now. It does mean, though, we do need to see some adjustment in terms of the copper primary supply side. We're looking at in the order of 300 to 500,000 tonnes of copper because scrap is doing more than 1 million tonnes of adjustment, just as it did in 2009. Longer term, the demand environment for copper still looks positive to us. Of course, copper into electric vehicles and renewable energy, both of which are more copper intensive than the incumbents in those markets at the current time. So copper is still one where we expect a higher long run price than we're seeing today, but the deficit for 2020 has been lost. Copper, in our view, will outperform during the recovery period of the cycle through late in the second half of this year. And just a quick word on some of the more challenged commodities out there. Well, the ones that are challenged are the ones that have had high overcapacity coming in to this downturn. We'd highlight there steel, aluminium and bulk freight. And they're the ones where we're having to see more aggressive supply adjustment. So in the aluminium market, we're expecting to see as much as 4 million tonnes of supply adjustment. We've been in a surplus of more than 2 million tonnes year to date. But we do think if supply cuts come through quickly enough, we can get back to seasonal inventory flows by the second half of the year. It does also mean that things like metals financing, which are very prevalent in the 2009 to 2013 period, are actually coming back. You can make a good return from financing material into the forward curve. Certainly something that we expect to see perhaps more producers and consumers do over the next little while in order to help fund their working capital situation. But it is what this inventory build, of course, does act as a buffer on the upside, and it does slow down any price recovery that you may see in these markets. And I'm going to leave you with the chart that many of you have seen before. It's the BMO commodity comparison chart. It shows on the x-axis that's the potential for a long-term shortage. On the y-axis it's potential for short-term constraint. And of course the commodities can move about in this over time. Top right is good, bottom left is generally bad. A couple of things to highlight. Uranium is moving out of the bad zone following the deficit that we're seeing that is drawing down some inventories. In terms of it, there's not many short-term constraints out there at the current time. Those that are there, manganese ore for example, are more related to supply restrictions than aggressive demand. But on the whole, it's still, if we look to the right hand side of the chart, those for long-term constraint, still nickel and copper hold up very well in that regard, as does cobalt. With that, it just leaves me to say thank you for viewing this videocast today. I hope you enjoy the one-to-one conference and it is productive for you. And if you have any questions, please do feel free to get in touch with me. My details are on the slide here. Thank you very much.